inflation and its impact on the economics of a business and its potential valuation without making a blanket judgment that inflation is bad for equities in general. It isn't.
So I really like the mention of the working capital thing. And right now, as Q4 results are getting declared and there are so many con calls. So one interesting thing which we have noticed is also that some of the management which had planned for capex, they are now rethinking, because now they probably didn't expect the inflation to rise so much. So now the IRR of those capex are not coming to that attractive a point which they thought of, say, a couple of quarters or a year ago. So this is also an interesting point in terms of inflation.
Not only that, let me add to another nuance here, which I should have mentioned earlier. I talked about the impact of inflation and depreciation, and on businesses. But think about the cash flow statement. When I talk about working capital, same unit volume, no growth in the number of cars that you are selling, or the bikes that you are selling, or the kgs of tires that you are selling, or whatever you are selling. The kgs are the same, but because inventories are more expensive and receivables are carried at a higher nominal price, working capital requirements go up. That incremental change in working capital will be a item that will take away money from free cash flow. Your free cash flow will go down simply because of inflation, even though your business has not grown. Typically, growth in working capital is associated with growth in unit volume. Inflation almost always ensures rise in working capital and therefore a detraction from free cash flow. Those of you who study free cash flow statement, and you should, because it tells you that can this business fund its own growth. Forget growth. To even stay at the same level, you need more capital. So if you don't have the cash, then you have to borrow money. Impact on the balance sheet quality, on the P&L, because of extra interest that will have to be paid because of incremental debt that you take on. So there is this impact all over. Inflation can has an impact on the P&L. It has an impact on the balance sheet. It has an impact on the cash flow statement, and it's very interesting to see how that plays out over a period of time.
So I have another follow up on this. So there are several businesses which generally focus too much on this metric called EBITDA per ton.
Mm-hmm.
So in this inflationary environment, would it not be right for us to not just focus on that EBITDA per ton, but also simultaneously compare it with the actual P&L and cash flow? Because even though on an EBITDA per ton, they would be doing, just as you mentioned, they would be doing the same performance, but actually the business is getting hurt, right?
Absolutely, and I will just make the point that you meant. You said in this environment. I think it applies in every environment. You should not focus on EBITDA per ton in any environment. You should focus on true economic earnings on a per ton basis, or a per share basis, or whatever the denominator is, in every environment. EBITDA is just a number. It's a number which is highlighted a lot because it makes you look better than what you really are. So I just don't like the idea. I'm not the only one. Any financial analyst will tell you the same thing. EBITDA is not earnings. So be careful about EBITDA in any case. And yes, you're right about the fact that because of inflation, companies whose ratio of EBITDA to true economic earnings was will become worse because of inflation. That point is completely correct.
Right. So, sir, next two questions will be specifically on valuation. So, the first question would be related to the moated business. So, with your experience, how easy or difficult or what kind of problems you have come across when you are valuing moated business?
See, the problem is actually about the way the world is changing very rapidly. The pace of change is only accelerating, and it's very difficult to uh, visualize. So one of the filters that I use is that how sure am I that the basic need that this business serves will be around. But it's not sufficient anymore to ask that question. You have to also ask the next question as to how sure am I that this industry will be serving that need. You know, the people need torches to go in the. People need light to move around in dark places, and the need was served by torches. But people don't buy torches anymore, right? Because they are built into the mobile phones. So the mobile phone industry disrupted the torch industry, so to speak. Just an example to illustrate the point I'm making. The need may be there, but the need may be served by a completely different industry, and you don't even know that. So you have to be careful about that part. So when it comes to valuation, all valuation is thinking about the future, right? So you are trying to stay away from things that you can't predict, and it's good becoming increasingly hard for one to predict the future in terms of what the business will look like 10 years from now, when you can't even be sure about the need that the business serves, and whether the need will be served by this industry or some other industry. Then how can you be sure about this particular business? So that's one big challenge that I have to face with all the time. um, the other thing that has happened is that when you're making predictions about the future, how far, and as I mentioned, you can't think very far out. So how do you adapt for that? Instead of making explicit forecasts, like I did, I did a case on Relaxo many years ago, and it's out there, where I made some assumptions about unit economics and how the per pair economics will change over time, and how the business will use its pricing power, and so on and so forth. And they actually turn out to do way better than what I expected, but that's not always the case, by the way. But the point is that this kind of explicit forecasting, which was being done by me as late as 2012, 13, 14, I don't, I feel uncomfortable doing it now. So the way I think about valuation now is different from the way I thought about valuation uh, when I did the Relaxo lecture. So my thinking is basically that I don't want to pay at the portfolio level, and this is important. At the portfolio level, I don't want to pay significantly more than what I would pay for a non-growing perpetuity in a AAA bond. So if AAA bonds are yielding say 9%, just take for the sake of example, then the pre-tax multiple is 11, um, and the bond will never pay more. So it's a non-growing perpetuity, and it's AAA, so it's high quality. So you're certain about the fact that you will get the money whenever it is due to you. So what that means is that if I ensure that if I'm buying into a growing perpetuity where I'm sure about growth, uh, I don't want to pay for the growth component at the portfolio level, or I don't want to pay a lot of money for the growth component at the portfolio level. So that kind of thinking basically reduces the need to make explicit forecasts about unit economics, market share, DCF assumptions, and all going forward to 10, 15, 20 years. Uh, Now, when I say the portfolio at the portfolio level, what does that mean? What that means is that uh, there is a way to invest in high quality businesses where you would allow some positions to be bought at multiples where you're paying for growth. You're hopefully not paying a lot for growth, and hopefully you're buying growth at a very reasonable price, but you're paying for growth because the multiple is way more than 11 times pre-tax earnings using the method that I just described. Uh, then, but at the portfolio level, you can still keep the overall multiple not too far away from that what would be paid for a perpetuity in a bond portfolio. And the way to do that, of course, is to keep the weightages of the high P multiple stocks low, and to increase the weightages where you're getting growth for free. So, hopefully and today is such an environment, by the way. We are looking at hopefully a bear market right now, and things are becoming quite interesting. And therefore, there might be businesses out there which will grow their earnings, but are priced at single digit multiples of their pre-tax owner earnings, and therefore one is not paying anything for growth. One is actually getting the growth component for free. So if you increase the weightages of those businesses in the portfolio and still have some businesses where you're paying for growth and paying up for that quality, then the overall portfolio is still, I think, very attractively priced. So that's the way I think about valuation at the individual level. at the portfolio level. Instead of making explicit forecasts, I prefer to and I've given you the reasons for that. One is that the world is changing, disruption is here, how to visualize the future, how to think about the basic the even the whether the need that this business serves will be served by this company or this industry or some other industry and so on, and how to still be a value investor and try to bring in some discipline about not trying to overpay for anything.
So if I would like to summarize, would it be fair to say that you want to keep a DCF frame of mind, but you don't do explicit DCF forecast today in your valuation?
That is absolutely correct. DCF frame of mind is very interesting because there are events which happen in the life of a company or of a stock market which makes you become more rational when you think about DCF frame of mind. That the for example, when COVID happened, the earnings of many businesses were decimated. But then, if you put yourself in the DCF frame of mind, you think along the following lines that okay, pandemics happen, they have happened in the past, economies bounce back. This company has a strong balance sheet. It's not going to die. At most, it will give up its earnings in the next 2 years. Can it handle the pain? Yes. But what happens to value? Value will certainly go down because the earnings will collapse, but they're not going away forever, right? They're going away for 2 years or maybe 3 years. So you put that in your mental model, DCA model, and figure out what is the impairment. There is an impairment, but the market price will be down 70%, and the actual impairment that is warranted is maybe 15% or 20%. Because if you remove 1 or 2 years of near term earnings in a business that is going to grow its earnings over a long period of time, very intuitively, the impairment is not 70, 60, 70%. So that kind of thinking is very helpful when you have that mindset. But it's again, the problem is psychological. When it was March 2020, it's hard to think that the world is not going to come to an end, because when the world is thought by people to come to an end, then DCF is not very relevant, because at the end of the day, if the world is actually going to come to an end, then the present value of future cash flows don't matter, right? Because there is no future out there. So if that's what people are thinking, your assumption has to be almost always that they're wrong, that things do recover. Um, Humans have a way of creating a lot of problems, but also solving problems. So, and that happened. That's exactly how it played out. And the assumption that all businesses are not worth owning also turn out to be wrong. Some businesses thrived in that kind of an atmosphere. Some businesses got hurt. Some businesses benefited massively when COVID went away because of the pent up demand that was to be fulfilled, and so on. So there are so many things that happen, and to assume that all businesses are not worth owning and get out of equities and go into bonds was almost always a wrong idea in during such periods, at least historically speaking.
I have another follow-up on that. So this was an interesting point. So while you said that you will look at some businesses where probably because of COVID, their earnings will be impacted for maybe 1 year or 2 years, and but the business is going to be there. The balance sheet is going to be very strong. And I'm just adding one another aspect to it. The industry is also the competitive intensity of the industry is going down because there are a lot of unorganized players. I don't want to name an industry and name companies here, but just a construct here, because we actually went through that and I actually felt this thing. So the competitive intensity has gone down. The balance sheet is strong. The earnings, at least for the next 2 years, is going to be uh, significantly impaired. Okay.
Yeah.
Now you realize the opportunity and you buy the stock. Okay. Now let's fast forward 2 years. The earnings have still not come up, but the COVID is again is past us. The market's view of that business and that industry has suddenly become much more favorable, and the stock has also gone up a lot. When I say lot, maybe a 2x or a 3x from the level of March 2020. and you still recognize that the business do have a tailwind and the business does have the earnings, but how much of that is already in the price is the dilemma. How do you get
So the way
look
to
at
do
this?
that is to think of cycles. You have cyclical industry. How do you evaluate cyclical industries? In a cyclical industry, you use averages, right? You don't look at PE multiple based on last 12 months earnings because earnings are inflated. A low PE multiple, when the PE multiple is calculated based on peak earnings of a cyclical industry, is actually a trap. And people who invest in cycles know this, right? They don't calculate PE multiples based on TTM. They calculate based on average over average, year over a cycle. So they take the good years and the bad years, and as Graham used to say, average the past, and always try to average the past. So in cycles we do that. Basically, the idea is that there will be good years and there is the bad years, and averaged out over a cycle, this is what a business makes on a per year basis. Therefore, this is the average EPS, and this is the price, and this is the multiple, and therefore it's attractive. Why can we not use the same framework while evaluating businesses when they get hit by something like a pandemic? The same logic applies, right? So, how cheap or expensive the business is based on average earning power. Imagine that the period during which COVID happened was an extraordinary period, not likely to be repeated for a long, long time. And therefore, the earnings that were not earned were extraordinary losses, just like you trying to ignore extraordinary profits while doing valuation, or you put very low multiple on that part of earnings that are truly extraordinary, not likely to be repeated. Same logic can also be applied to losses, right? So I don't know the name of the stock, I don't need to know, but the method to follow here is how cheap or expensive the stock is in relation to normal earning power compared to other opportunities that you also have at any given point of time, because you have limited capital, everybody has limited capital. So it all depends on how attractively priced the stock is based on average past earning power, or what you can visualize in the next 3 4 years on average. What is the average earnings that the business will make on an annual basis over the next 3 4 5 years, or what do you think the business will be earning 3 years, 4 years, 5 years on the road? How expensive it is. The stock may have gone up, but as you said, the earnings have not caught up as much as should have happened. Therefore, the multiple has gone up. But if earnings will catch up with with the past deficit in earnings in the next 1 or 2 years, then it might make sense for you to hold it. You have to make that judgment, and it's not going to be an easy judgment, by the way. It's never easy to make these judgments because there's always something else that is going on which looks much more compelling, and then you switch out of that into something which looks more compelling, and it turns out that the other thing went up much more than the one you bought. So those things happen all the time.
That reminds me of that quote. I don't know who said this, that capital is limited and opportunities are unlimited. So that is also a problem.
Yeah.
So moving on to the next question on valuation. So what's your general sense of valuation of the new age startups that got listed on the exchange in the last year? So there was some huge euphoria at the time of the IPOs, and now we know that they have all fallen somewhere between 30 to 70% from their IPO price. So we all know that these startups are becoming an integral part of our lives. But the $1 million question is, how can investors value them? What are your thoughts on this? Is market painting everything with the same brush, and is there an opportunity for a hardworking investor here?
Well, anybody who studies history of markets would have seen the same story play out. It's like not the first time it has happened. IPO bubbles have been very much a part of life of a stock market in almost every country. So and every story, the outcome is the same. IPOs turn out to be a sort of a sucker's game. I mean, it is a rigged game, but many men want to play that game because some IPOs have done well for their brother-in-laws, and then there is FOMO, fear of missing out, and there is ROMO, the regret of missing out, because you've seen your neighbor getting rich, or your school buddy getting rich, or your brother-in-law getting rich, and then you even call up a banker and fight with them as to why they have not given you the loan to invest in an IPO, and you see the consequences